Okay. Why don't we just go down the road? We'll start off with you. If you can cash your mic down. Who are you and what do you focus on?
Hey everybody, my name is Mike MacCombie. I represent two hats. One is I run a fund called Generous Ventures, early stage pre-seed and seed, vertical AI, specifically when there's an element of compliance tech, orchestration, or unique data information. I also am a venture partner at Motley Fool Ventures, writing Series A checks, usually broader spectrum, enterprise software, but inclusive of fintech, tech, anywhere they go, but more traditional software rather than deep tech, CPG, sciences, and FDA clearance related companies. But one thing I'll note is I run 22 communities, including one of about 180 Series A investors. So whenever you get to the point where you're raising a Series A round, I'm happy to be a connective tissue to that group.
Hi, I'm Kate. I'm an investor at Bullpen Capital. We invest seed through Series A, pretty generalist across consumer and B2B, and across sectors, healthcare, fintech, verticalized SaaS, and AI. Hey, my name's Morgan. I'm a partner at M13. We're based in New York, San Francisco, and LA, and we lead seed and Series A rounds. I focus on two major categories, but the fund is a generalist fund, both consumer and enterprise. Myself, I focus a lot on our healthcare investments as well as our work and automation investments. For me, that mostly ends up being overlooked sectors, industries, areas of regulatory complexity and adoption. That's interesting to you. Happy to chat.
Hi, my name is Aaron. I'm a principal at Nordzone. We're a global multi-stage firm focusing primarily on Series A and Series B investments. We're a generalist fund. We've done everything from like application layers, foundation models to autonomous drones across consumer and B2B. I focus on New York and East Coast investments, generally data and AI businesses with a B2B go-to-market focus.
So founders have been told to never stop raising. I'm sure you're all thrilled at that. But at some point, they need to actually run the company, hit the milestones. And so just quick lightning round across. Do you have any good specific examples of a way that a founder stayed engaged in a way that was intentional and productive versus performative that you appreciated and you would recommend to your portfolio?
So I actually don't 100% agree with the idea of always be raising. I think it's important to build relationships with a select number of investors over time. And then it's actually sometimes going to benefit to hold others at bay. We were talking about this at one of the tables, but it's a little bit like dating in that you don't want to be too available all the time. More specifically, I think that the point of building these select relationships is really to help get to know the investor, but also to show them your rate of growth over time. And so the way to be very intentional about that is to reach out and give updates that are really meaningful at select periods of time rather than always being on their calendar. So that whether that be major product updates, major milestones when it comes to a commercial perspective, maybe a really big and important hire. Those are the ways that we've seen it done best.
Aaron just got engaged. So if you do need dating,
6 years out of the market, so what do I know?
I would generally echo, I think that is the right way to start building those relationships to hopefully foster successful fundraisers. I would also say one creative thing I've seen or something that I think appeals is kind of talking to VCs through your customers. I find that to be really interesting. And that can be around conferences. There's certain conferences that VCs like that. So attend, whether it's maybe a security conference or that. Not in every sector, but certainly in healthcare, there's traditional healthcare conferences. Sort of having, your booth is smart by customer. There's just energy around your booth. You maybe ask about things and then catch up with them at a conference where you're doing business and they see that you're out there sort of working. This worked well for some of my portfolios as well. And I think you can also sort of echo that sentiment via sort of whether it's, content or, maybe if you're blog posts and LinkedIn, so around customer kind of goal, because that really does get VCs excited. And then by the way, if it is actually resonating with customers, this happened to me recently in investment, you are talking to customers touching multiple different products and sometimes other names come up, right? And so I think that natural sort of updates through basically demonstrating EMF and customer love are really interesting. And I think there are some ways to be intentional about it. But that's maybe one creative way that I think is pretty interesting.
I really do think social media hype works. So if you're posting things publicly, both to generate customer interest, also can work as a way for investors to start tracking you. And then once you have that conversation, something that I think has been really effective. There's a founder I'm trying to build a relationship with now. He's trying to fill me out. I'm trying to fill him out, vice versa. And in his newsletter updates that I know he's sending to other investors, he's putting an ask at the bottom, something very specific. We're looking to see these type of customers. And I love, both a specific ask, but also it puts it back on the investor and start adding value to you as the founder early. Yeah. And it helps me, just with him being as direct as possible, it helps me have a way to be like, okay, I want to reconnect with him given, the recent traction and progress that they made.
So is there legal tech TikTok, or is that like what? Unfortunately, doesn't matter.
I mean, LinkedIn is kind of scary these days, but I really think LinkedIn can work. Yeah. But I don't know, for some consumer companies, yeah, TikTok, Instagram.
I think X is still really small.
Yeah. Yeah, of course. Yeah.
I'll throw a couple of the obvious basic ones, but a little bit of point of view on the others. One, I particularly invest in companies that aren't hypey. I like the ones that are understated. So I believe very much in put out content that is true. I don't like anything like, oh, we're so excited to have brought in this new investor. Like, no, we're great. We're working with great partners who bring us X, Y, Z. I take a particular approach. I'm a little bit more of an East Coast style. A few things I would say is just the good old fundamental of a well-written investor update on a regular monthly cadence. That's plenty enough. I'm a single guy, so I can't talk to like what's successful in terms of overabundance or not. I would say generally showing that you're keeping everybody in the loop. I'd say any investor I meet that I want to keep in touch, I just say, hey, I'll add you to the monthly. You can keep track of data over time. Sharing it out, I think, definitely agree on the asks. And one trick that I saw is two things from one of the best investor update writing founders I know is they would have very specific asks, but not just specific, but very actionable. If they said, hey, we want intros to any of these 15 customers, they would not do an Excel sheet saying, hey, look through. They did a singular search on LinkedIn. You could click once, see all the connections you had in the top, first, secondary connections. And you can basically say, I know these 15 customers without having to do a lot of work. So minimize cognitive load asks on the investor updates goes far. Frankly, shout outs work too. I'm a former teacher in my first career. People like knowing when it's actually being watched, that people are helpful. And if you're a Series A investor, you like being able to prove you've done the thing. So I'd say that's in there too. The last thing I would say is definitely case studies on social media platforms, be it on X, on LinkedIn, or something else saying, hey, we're recognizing this is a big thing that customers like this are realizing there's the value in what they do. So I think a lot more of just showing what you're saying before about the customer momentum and the customer love. And lastly, if it's customers that are startups or customers that have a lot of other investors, saying, hey, if you know anybody that likes to invest in tech for your kind of companies, you can always get throughput on that. I believe in just saying, hey, keep people in your orbit. I don't think you need to necessarily focus because you never know when somebody's going through a new fundraise or when they're not in their deployment cycle or when they're only doing follow-ons and they have to hunt down the hatches. If you're focusing on 5 or so investors, you might get 2 or 3 that are actively deploying at the right stage when they're going for the company. So I'd say give yourself a little bit more of a chance for serendipity when you do that.
One of the things I'll also add to that, I actually, probably because I was a first check investor, which is a little different than a Series A, I never really liked the update email just because as a first check investor, if I passed, I'd probably never ever want to hear from you again because you'd probably race with somebody else. Different for Series A that builds a relationship over time. But if you're going to email me, I wanted it to be specific to me. And in a world where you can transcribe every conversation that you have someone and use AI to sort of manage and get specific and track, it's not that hard to be like, we referenced our enterprise strategy in our meeting and we just closed our first 2. So for you specifically, person who tried to pitch me their fund based on their enterprise relationships, can you do this for me? Versus someone who in a meeting stated that they had a product round and like catering that email to them. So just try and make it like less generic can be done at scale without much time. Aaron, I'll ask you, and then, Mike, if you want to add on. Sometimes I feel like there's this back and forth of how much are you raising? What's your sweet spot? This is the same way, dealing with any kind of, contractor, consultant. How much do you charge? What's your budget? If I'm genuinely not sure, or if I sort of feel like if you gave me $15 million, I'd know what to do with it, but I know your sweet spot is more 30. How I manage that conversation, I feel like I'll be successful no matter what kind of check you give me. I don't want to seem unsure. I don't want to seem desperate. Literally, there is some flexibility in the model.
Yeah, I think a few things. When it comes to actual active rounds that you're running, I think it's generally better to have a concrete number or a very tight range that you're asking for. I think it's really hard for you to manage the narrative correctly when you give such a broad range that doesn't come off in a way where you're just unsure. I think you can bring that into play more if you have like a competitive round in the mid-round process where you can say, hey, we wanted to raise X amount, but the round is very, we're seeing a lot of interest and we're considering upsizing the round to let people that we like into the round, and here are the reasons why we can use it. Outside of an actual round, I have mixed feelings. I think that the way to discover the market's appetite for the round size is actually something that you can use existing investors for. It's really hard for you to iteratively go with potential new investors, be like, I'm thinking about raising this or that. Like, what do you think? Because candidly, half the time, unless you're giving them so much insight into how the business is going, they don't really know, And so I think that's an instance where you can go with your existing investors, be like, as they're catching up with downstream investors, play this game around, hey, I'm curious how you think about the sector that you're in. What are you seeing in terms of metrics and round size, and how do you guys think about valuing the business? Like, that's the way that I would go about it.
Yeah, I would add in, I agree, one, just right size it with your previous investors. Anytime I see a deck where it's like, we're raising 2 to 4 million, I say, this is so much uncertainty. I think one way to map it out is saying, what is your minimum raise that you need to do to hit the goals? And if you really want to give people an option, scenario map it and say, hey, based on this raise, this is what we can do. Based on this raise, this is what we think we can do. But I'd save that more for if they ask for a model and saying, hey, our checks are too big, or we don't think you have enough ownership for us. So I'd say go with the minimum raise, what's required, and then allow yourself the flexibility, especially mid-raise or what you're doing. But you can always scenario map it in your financial model if they ask like, hey, could you make use of a $5 million check if you're only raising 3?
I would say the only other thing to add in is it's always easier to upsize a round than downsize a round. So there's like signaling implied if you go out really strong with a number and then, 3 weeks later, other people get a smaller number and like people talk. And so I would say like, yeah, start with your minimum for sure. And it's always nice to have a talk track of we're oversubscribed. There's so much demand that we're increasing the round. You kind of always move up. It is somewhat of a conversation, but moving down is not ideal.
We have a lot of New Yorkers here, but not everyone. Not everybody cares from a real venture city. Some people from Boston. Sorry, I get that. If you're a founder without a deep network of investors, you come from industry, and you're really feeling like you're maybe starting from scratch a little bit. Like even some of the seed rounds here might have been done by people they already had relationships with, but the Series A sort of new thing. What are some of the best ways to start out and build an investor relationship over the last year and Kate, if you know?
Okay, yeah, I was gonna say, I think if you're starting from scratch, I think the best bet is to actually spend time with each other. There's so many events for founders in these, even in Boston. There's so many events and there's so many opportunities to get together, and founders do want to genuinely help each other out. They have those connections, especially on their cap table, and obviously they're not just going to introduce anyone to their cap table, but if it's the right fit, like there's actually some really warm connection for them to me. Also, I know investors who it didn't really work out for them to invest, but think if they could put you in punch. Like I get founder referrals all the time, and I usually take them, especially if the founder is high signal. And so I would say that's an easier place to start because they know what you're going through and they were there once too. And most founders I know want to get back. So if you're starting from scratch, I would recommend just building your network. Also, there's a lot of great parties that have nothing to do with actually like the business building side. So if you approach that with genuine sort of like relationship building, that would be really helpful. I also think the other thing is it is a very small ecosystem. So you're probably less known than you think you are. It could be one founder, one investor, another investor, right? So it can compound quickly. And so I would say, think about, the other people in your orbit, how many degrees away you are from someone you want to get to. So I think the founder up is a little bit more organic than going very targeted and asking for direct intros. Like sometimes that works. I would say my highest hit rate is if a founder I really respect since the founder.
Honestly, nothing to add. Yeah, I covered it.
That's it's okay. You can get the next question. How do I know for a Series A, what's an appropriate funnel to start out with? And just in terms of size, number of people I should be talking to at any given time, and the number of active relationships is sort of reasonable to be maintaining during the race.
Yeah, I think if you're putting together a list for a Series A raise, I would lean a lot on your seed investors. Even if they haven't volunteered this, ask them to go through the exercise with you of putting together a list of investors that they would recommend that you meet with. I mean, hopefully at that stage, they're very actively thinking about it. And what we do with our portfolio companies going into an A or B is we'll start with honestly as big of a list as we can reasonably put together. And I think it's a lot easier to do now with AI tools, but start with a list and tier your intros based on, certain things that you're indexing for. So whether it's sector specific expertise, but you also want to talk with some generalists, maybe multi-stage firms. Yeah, prioritize them tier 1, tier 2, and tier 3, and then just start to prioritize those conversations accordingly. But I would try to sequence things so that you're doing as many conversations up front as you can. And then if you need to slow things down on your end as you're going through diligence with multiple firms, you can deal with that later. But I would try to do as many of the first conversations up front as possible.
Aaron, how should people think about breaking out that pipeline, what stages to actually move people through?
I think you can think about the fundraising funnel in 3 main steps, and then there are interim steps. But the three main ones are like, first, you've met somebody at the firm. The second one is you've met somebody who has check writing capability. And the third is that you've presented to investment committee. And so those are the big mechanical steps that I would think about. And there are like really big differences between them. You should sort of always expect that, like, if a firm is excited about you, they're moving with speed and they're getting you to meet more people in the firm. And if they're not doing that, it's an important signal for you to pay attention to. Beyond that, there are like mechanical things. It's like, after you've met, you probably share the data room. After the data room, there's like speaking to customers through B2B, some sort of user interview. And then like towards the end, if they're doing like founder references on you, like you're hearing like some from a friend or something like that, like, hey, this venture firm like pinged me on LinkedIn asking for a chat about you. Like that's like a really strong signal. But I think the 3 main stages are the ones that I listed at the beginning.
So my parent brought up data room, which is really important for Series A because hopefully by now you have some data. And from the data rooms that you've seen, what are some things that like need to be done better that probably need an extra turn or two?
So I'm only
Is it off?
unsure. Yeah. So I can share an example from a company that we just invested in, and they had a lot of loving that needed to come through in the data room. I'm going to say some of these things you probably won't be at the stage where you have to do, but just in case, make sure your P&L is an Excel formula and not just sort of a year-end summary in case you want to go by month on month to sort of track your growth. Very helpful to do. Generally, the things that I think I see a lot in data rooms are, one, you're proving that people are buying, but I'm not quite seeing why or how deeply they need the product as you're going through. So whether that's customer testimonials, whether that's referrals, whether it's a proof of sort of the source of attribution, I personally, when I'm looking at it, I want to see that there's a growth engine, not just founder-led sales or in-network customers. So if you can show me, here's a pipeline of our increasing ACV over time, our increasing sort of distance from initial contact as to who we're getting, and testimonials of this is exactly why we needed it. And it's not just sort of we could see this being a product that we might find high value, but saying, no, we would be sorely remiss if we didn't keep this product. I think it's the biggest thing because especially depending on the contract sizes and the growth rate you have, if I know whatever customers you have, they absolutely love you, and they're showing that's the reason, I think it's the biggest thing that I think drives a lot more conviction other than just the solid high growth rates, high gross margins, et cetera. That's what I would say is the main thing.
Or anything?
I think you covered most of it. I would just say the one thing that I feel like is often missing is like just great data around stickiness and retention. I think that especially in this environment, lots of people are growing. It's very hard to delineate sort of like what is high quality revenue versus low quality revenue. Anything you can show about sort of like anything around like usage and sort of like expansion, just even from a revenue perspective, sort of from a product path perspective, is very, very interesting to explain the data perspective. It can be hard because really it's something we're tracking. I think the other interesting thing is we see with startup companies, but leading indicators of revenue as well are really interesting for a company that isn't that has like maybe a longer sales cycle, like enterprise contracts or government or something like that. Just like what are the signals that you look at before you see revenue? And those often get people really excited actually in assets.
Some founders are learning about the funds that we have up here for the first time and adding them to their list and their funnels and all that. What are the best ways, if I find out about your fund for the first time and hear about you and you seem reasonable, what should some of the research be the next steps to figure out whether or not you're a fit? Like, what are the best ways that a founder can due diligence an investment?
take a look at the website, see what other investments we've done. I also think specifically for Bullpen, we've been around for 15 years. The strategy has changed a little bit. So if founders have a better understanding maybe of recent investments we've done through, press releases of companies that we've invested in that our firm has mentioned as one of the co-investors, that should help you start to get a better sense of where we like to invest. But always happy to share more detail in one-on-one conversations.
And I'll speak from the funds that have not been around for 15 years and might be a little bit more early on the stage. I think especially if you're looking at solo GPs or emerging managers that are going through, one, I'd be looking at seeing what kind of profile, what kind of reputation are they building across the board that could be public in terms of the content they're publishing. Do they take a point of view? Do they have a certain perspective they're going for? Two, assuming they've got a portfolio of more than a couple of founders. I think this is more later in the diligence funnel rather than early on. So like, hey, who have you worked for? What's been the companies that you've helped out the most? There was a company that I did recently and they just said, hey, talk to me about the last two companies you invested in. What have you done for them so far? And especially, I think if you can reference from founders that things have not gone well with, saying, okay, when you were shutting down, when you were struggling, how did they step up? Did they support? Did they just say, hey, I don't care? Or hey, take as many swings as you want? What was their approach and their mindset? I think the other thing I wouldn't forget to underscore is being self-aware of what matters most to you. Some founders just want to get the investors good passive out of the way, someone very highly involved for customer intros and hiring. I talked with the founder earlier today who said, hey, I don't know if I want to bring somebody on for Series A. What are the biggest 3 points of leverage that you need? Find out who is known for those points of leverage, whether it's hiring, whether it's on go-to-market strategy, whether it's on firming up for later stage rounds. Knowing yourself and what you need helps you diligence better for the factors outside of just, are they a good person with good character? If you know any early stage investors that have worked with them, mutual connections on LinkedIn, find out what's your reputation. They never like to say it publicly, but they'll sort of like, are they saying good things or are they not saying anything at all? And that's a good enough indicator for you. The ones I like a lot. The ones I don't, actually, I'll be pretty blunt about the ones I don't like, but usually people won't say anything. That's a pretty good indicator on itself.
So a couple months ago, I actually had Edmund on a panel about raising seed from specialist funds versus generalist funds. And all three of the people on the panel were in areas that had specialist funds in their sector. And they said that was some of the worst pitching they had ever done. I think maybe because the specialist funds sort of knew all the bad stuff about their space early on. But you do have to find sort of a rightness of fit, right? And you want to find somebody who at least knows something about your space and not necessarily have to reinvent the wheel every time. Morgan and Aaron, I'm curious, how should founders think about specifically trying to zero in on somebody who should know a lot about the space already versus possibly going to a more generalist fund?
I think the first thing I'll say is, I think there just aren't that many specialist firms at Series A and onwards, just by nature of the amount of capital you need to deploy. And so I think that's becoming a little bit more rare. I mean, the most specialized that we generally see at this point is we only do B2B or we only do consumer. So I don't know if that trade-off is actually as prevalent at Series A anymore. I think when it comes to the individual, it really depends on what you're looking for, which sounds like a little bit of a cop-out answer, but it really just depends on the type of founder that you are. Maybe you feel really strong at the product and the tech, but you want help on go-to-market. So in which case you might want to find a partner who is an ex-founder, has a really extensive network. Maybe you're a young founder who wants to find somebody who's in the trenches with you and you want to find a younger investor. But I don't know that the whole generalist or specialist differentiation is as prevalent these days. Though I do think that my observation hearing from founders is that specialist funds or investors tend to have a more prescriptive view on the world. And so you have to overcome that much more unless you happen to have the exact same worldview as them.
Yeah, I would tend to agree. There's not a lot of specialists out there in reality. Even the specialists, I think, are broader than they may appear on the surface, right? And that's just a function of everyone's looking for an output, and you need to be flexible in where you find it. I would say there are, I've come across them in robotics and mobility, where there really is people who have just seen the reps and been in the industry a long time. And now where they can be very valuable is their LP base is sometimes actually the end, customers for your product. And so I've seen that be very useful. I do think given that most people are generalists, like I was really expect much more details, and I would use those people as like great resources, and I would see them more. And I think they tend to play in this role as like great additions to a round, right? Versus like maybe the lead investor. And maybe there's some probably exceptions in that space. But I would say like overall, like a lot of like strategics and, you know, specialists like can be very value add. I think it's better though to have someone with a broader mandate and more flexibility. I was like, even companies move it and things change, right? And so I think like, you know, I think you want to give yourself the closest one and most access to you know, flexible funding in the future. But those will be valuable from like a very tactful, strategic, LP-based perspective. The other thing I would say is like even within a large generalist fund or any type of generalist fund, people who do different things within the fund. So there's definitely like the fintech person, right? And they don't necessarily, you know, have a fintech fund, right? But would say like, you know, maybe they dabble with a few sectors, but like there's not a lot of other people in the fund that would do a fintech deal without that person. So you are still looking for the right person in a generalist fund. It's the same with like defense tech. You know, there's certain people within these funds that activate these deals and others who sort of stay away. So there is still some navigating on that specialization, even within like a larger fund.
Cool. I see Ryan waiting in the wings. So just one quick, if there's like one or two words on something that founders should de-risk before the Series A, what is the one thing that if you can just leave them walking out of here with like one thing they really got to get to before they get a check from a Series A fund and we'll go down the line?
I think it's basically product market fit.
Product market fit.
Yeah, primary fit. I see a team and need just like more than the founding team. It's like have you brought in amazing people behind you and have you built out your leadership bench? Or at least are you on the verge of that? But I think team for me
Relates to product market fit, I would say having a very defined ICP and examples of that from multiple of existing.
And I would say growing from that, probably evidence that you can move from a one-off, we found a good customer within network, to we actually are building a machine where we at least know who we're going to, how consistent they are, and how we build channels to build up distribution leverage over time. That's probably the biggest thing the biggest leverage point of de-risking that I've seen.
Awesome. Thanks for having us.